Hi everyone, welcome to our event for today. Today's event is brought to you by Bursa Malaysia together with Maybank Investment Bank. Why Malaysia? To answer that question, we have two very interesting sessions for today. Starting off with the first session to touch more on Malaysia outlook, followed by a panel session with key captains at 4 p.m. later. All right, so let's begin with our very first session. We have our very own Chief Economist, Suhaimi Ilias, together with Anand Pathmakanthan, Malaysia Head of Research. So without further ado, let's hear it from you, Suhaimi.
Hi, thank you, Amira. Assalamualaikum and good afternoon, everyone. Thank you for having me here this afternoon. I will, plunge headlong straight away into my presentation on the recent developments concerning Malaysian economy and what's the outlook that we think are in store for the second half of this year and next year. I guess first and foremost, I do apologize starting off this session with the slides that have tons of numbers there, but just want to highlight few key things from this particular tables. As we know, last Friday, second quarter 2022 GDP was released. Economic growth picked up to 8.9% from 5% in the first quarter of this year. I think equally important is after the recession in 2020 that was due to the pandemic and a somewhat underwhelming recovery in 2021 because we were still in and out of lockdowns last year. For the first half of this year, economic growth momentum has certainly strengthened to register a growth of 6.9%. I think as per the title of my presentation about you will notice there was that word sugar rush. Basically, the economy benefited from full opening this year, particularly with the opening of the international borders on 1st April of this year. And consequently, you will notice from these slides here, the two largest segments of the economy on the supply side and demand side of the economy are the one that posted the strongest growth. So services, which is 57% of GDP, as you can see there, accelerated to 12% in the second quarter from 6.5% in the first quarter, giving a first half growth of slightly above 9%, certainly a much more better numbers than we had in 2021, underpinning the benefits from opening the economy. And on the other side of the coin of GDP, the demand side, the largest segment, which is private consumption, nearly 60% of GDP, also jumped to slightly above 18% in second quarter from 5.5% in the first quarter, giving growth of 11.5% in first half of this year. Again, a much better numbers than what we had last year. However, as you would notice from the column showing you our forecast for growth this year, next year, while 6% growth this year is certainly, I think, achievable, it does point to the fact that we are penciling in, pricing in, expecting moderation in growth to around 5% second half of this year and further to 4% next year. Why this is so? I think after the sugar rush, as usual, there is that withdrawal syndrome kind of thing. And in this, another slide that is laden with numbers, I just want to draw your attention to those sets of numbers that are within those dotted red line box there. The reason for us taking the view that economic activities will experience moderation second half of this year and next year is because for Malaysia, we will continue to experience this environment of rising inflation and rising interest rates. So you can see from the table there, we are looking at inflation rate of north of 3% this year, rising further to slightly above 4% next year from 2.5% this year. Certainly, there's a number of factors that are contributing to this, apart from the lingering effects from the surge in commodity prices, as well as the supply chain constraints that are still there. There are certainly unique factors to Malaysia, things like the prospect of rationalization of subsidies, particularly next year, as well as the impact to business costs arising from the implementation of the minimum wage hike that came into effect on the 1st May of this year. And as a result of that uptrend in inflation, we continue to expect Bank Negara to proceed with further hikes in the overnight policy rate, or OPR. I think in May and July, we have 2 rounds of increases totaling 50 basis points. And we are pricing in another 75 basis point increase in OPR, such that by first quarter of next year, we do see OPR being restored to its immediate pre-COVID level of 3%. However, I guess with the situation where the OPR is kind of lagging behind inflation, we will have negative real interest rates, along with a situation where we have a far more aggressive central banks in the United States, i.e. Federal Reserve raising interest rate, relative to Bank Negara's measured and gradual increase in its benchmark interest rates, resulting in negative carry between United States and Malaysia's interest rates. The trade-off here is basically ringgit, which we can see here, where we expect it to pretty much remain around this 440, 445 level for the rest of the year, before gradually improving towards 420 by the end of next year. The other thing that I want to highlight from this table here is we are looking at a less expansionary fiscal policy next year, with a lower budget deficit to GDP ratio of 5%. This is after budget deficit to GDP ratio around 6% or more since 2020. So the next few slides are just to show you this impact, a positive impact to the economy from a full economic opening, particularly in the first half of this year, as can be seen from the mobility indicators on mobility, indicators on automotive fuel sales that shot up in the first half of this year, as well as the recovery trend in the air passenger traffic, as well as the numbers of flights. I think first half, the economy also benefited from what I call EPF stimulus. There was another round of withdrawals, pengeluaran khas or special withdrawal in the month of April, May. And I think probably people kind of forgot also that the options for lower workers' contribution rate of 9% as opposed to the statutory 11% that was announced for last year has been extended into the first half of this year. So EPF stimulus also contributed to the robust performance of the economy in the first half of this year, aside from full opening of the economy. And we saw its positive impact on consumer spending as per the chart on the right-hand side of the screen there. And with the opening of the economy, I think another key development that worth highlighting here is the improvement in the job market conditions, particularly in terms of unemployment rate that has gone sub 4% now for the first time since the pandemic era. And the other positive from the opening of the economy is obviously the improvement in job markets, in recovery in employment led to increase in workers' income as well, as per the chart on the far right of this screen here, showing you what happened to the private sector wages and salaries. But as I said, we will experience withdrawal syndrome after the sugar rush, primarily due to the unwinding and ending of domestic policy stimulus. I've stated at length about the unwinding of Bank Negara's accommodative monetary policy. The only thing I want to add now is we estimated that every 25 basis point increase in OPR cuts real GDP growth by 0.2 percentage point over a 12-month horizon. And the impact is particularly stronger, most visible after 6 months after the initial hike or the start of the increase in interest rates by central bank. And I think we will go through a situation where there will be no more EPF goodies. I think the focus by EPF from now on is on rebuilding retirement savings. And I think just to highlight an example of unwinding or ending of domestic policy stimulus and measures that were put in place during the pandemic years is the end of the sales tax exemption on passenger cars after 30th June. Certainly, there was a rush to buy and book cars ahead of the deadline for the end of the sales tax exemption on 30th of June. The other thing I want to highlight also, and was mentioned earlier in explaining why we expect continued upward trajectory in inflation rate this year, next year, is the expectation or our expectation of there being subsidy review or subsidy rationalization. And from this chart here, we can see that subsidies this year will be at record high, whether you look at it in terms of absolute value, in terms of percent of GDP or percent of federal government operating expenditure. And I guess the question of sustainability of such hefty, huge level of subsidies comes to mind. As for the nearly 80 billion ringgit subsidies this year, I think the bulk of it, nearly half, is due to fuel subsidies. And there's also other key elements there, including the cash handouts, as well as electricity subsidies and cooking oil price subsidies. But I think the point that I want to make about the issue of sustainability of subsidies is blanket subsidies are costly, such that if you look at the table, on the right-hand side of the screen there, ultimately the fiscal impact of crude oil price increase on the revenue, which is obviously the positive side of things, is virtually nearly wiped out by the increase in fuel subsidy costs. And this table just look at fuel subsidy costs in terms of the cost of RON 95 and diesel subsidies alone. But that resulted in the net fiscal effect of just 0.1% of GDP. However, if we include the fuel subsidy for LPGs, those subsidies for your cooking gas in that 14 kilogram, 16 kilogram cylinders, basically there is no positive impact at all to net. There is no net positive impact of this situation from the government perspective. And I think there's also, we have to admit to the fact that there are downsides from rising inflation, which obviously prompt Bank Negara to raise interest rate. That will have impact on cost of living. We estimated, for example, every 25 basis point increase in OPR will increase the cost of servicing your mortgages by 3%. And historically, we do see also a relationship between OPR and housing rent, which is not really surprising as landlords experience higher cost of mortgage servicing. They do pass on that increase in mortgage debt cost servicing to the tenants. And this is translated into that movement or positive correlation between OPR and housing rent, which is a component of CPI. And bear in mind, while private sector wages and salaries have certainly increased robustly, nearly 8% in the second quarter of this year, but once you adjusted it for inflation, then the private sector, real private sector wages and salary increase is cut to under 5%. And if you look at it from the perspective of wages and salaries per worker, the increase in real income is actually much slower at just 1.8% last quarter. I think beside the things that I've mentioned, mainly on the domestic front, there are external headwinds facing our economy in the next 18 months. Clearly, one thing that has been happening since March this year is the US Federal Reserve led a global monetary policy tightening. So I think with Fed being aggressive in terms of its interest rate hikes, such that I think we will be seeing a situation where by end of this year, the Fed fund rate will be in excess of 3%, much higher than the peak in the previous rate hike cycle between 2015 and 2018, when Fed fund rate peaked at 2.5%. certainly there's pressures for the rest of the world to kind of follow suit to partly manage the pressures on the currencies and manage capital flows, as well as dealing with a situation of rising domestic inflation. I think as far as inflation is concerned, the question now is whether it will persist or whether it is already in the process of peaking. Certainly, those with the school of thought of inflation peaking, I guess, we're taking note of the fact that the commodity price index has actually been heading downwards, at least in terms of slowing rate of increase on a year-to-year basis. But so far from this chart, we can see that despite the correction in global commodity prices, we noticed that the global producer prices have not really followed suit. It remains on an upward trajectory. So I guess that's where the argument or the debate about whether inflation globally is persisting or peaking will continue for some time. The other concern to me, looking at this chart, is the big gap between producer prices and consumer prices. So right now, businesses are trying not to pass through too much of their cost increases to consumers and resulting into a margin compression. But I guess the question is how long that can continue. So I think this is a space that we need to watch. And in relation to global commodity prices, I think the picture remains mixed at this point of time. The way we see it is that it is likely that going forward, as I mentioned, different commodities will display different trend. In particular, energy-related commodities, as per the top three charts here, will remain elevated, referring to crude oil, gas, and coal. This is due to energy security, energy energy price risk premium attached due to the geopolitical situation. However, I guess what's positive, particularly for consumers, is global food price index have come off. There's also a sense or indication that fertilizer price index, which is very important in terms of being one of the key components of the cost for producing foods, seems to have peaked. And the only, I would say, commodity segments that are really reflecting concerns about economic growth outlook going forward, hence sizable correction that has been seen in recent months or recent weeks, are the industrial metals price indices. And we're still going through some constraints on the supply chain, despite the fact that the indicators like the New York Fed's Global Supply Chain Pressure Index and the global manufacturing PMI's component for suppliers' delivery time has moved in the right direction, so to speak. But the global manufacturing PMI suppliers' delivery index remains sub 50. And New York Fed's Global Supply Chain Pressure Index deviation from mean is still high at around 2.5 times, as opposed to the plus minus 0.5 deviation from standard deviation from mean that we saw in the pre-COVID-19 situation or period. So I guess with the environment of rising global inflation, rising global interest rates, we're already seeing signs of slowing global economic activities and growth. The Global Composite Purchasing Managers Index, or PMI, the black line there, has generally been drifting lower, and that should translate into moderation in quarterly global real GDP growth. And then everybody's favorite kind of signal indicator of recession are certainly kind of signaling the risk of recession, given the inversion of the US Treasury 10-year, 2-year yield curve. I think at this point of time, we are looking at global economic growth to decelerate this year and next year. The signs were already there, particularly with the incoming second quarter GDP numbers for United States, for economies in Europe, for China, have certainly moderated or slowed quite substantially. Although right now, I think what is interesting is there are still divergences happening, particularly ASEAN countries or economies, including Malaysia, are showing sort of an uptrend in growth on a quarterly basis due to the favorable impact from economic opening. Nonetheless, I think we have to say that the outlook to growth forecasts are generally tilted towards the downside. And this chart just basically shows you some sensitivity analysis in terms of what are the impact from a 1 percentage point drop in global real GDP growth on the selected economies. For Malaysia, fairly substantial, where 1 percentage point drop in global real GDP growth can shave or knock off about almost 0.9 percentage point from our headline real GDP growth. Having said that, I think there are some mitigating factors to at least sustain positive growth on private consumption, for example, even if it's slowing. I think the opening of the international borders is important in terms of leading to or providing for recovery and revival of our tourism industry, which has been hard hit by the pandemic and the in and outs of lockdowns over the last 2 years. And bear in mind, tourism industry or sector accounted for 15% of our GDP and also provide for about 10 to 15% of real private consumption growth. The other thing I want to highlight is the chart on the right-hand side of the screen here that looks at individual savings and demand deposits in the banking system. Certainly, there has been quite a strong uptrend in the numbers since 2020, reflecting the impact from, among other things, the cash handouts, financial assistance, EPF withdrawals. So what we have here is pretty sizable excess savings in the economy. This, I think, has been instrumental in providing that kind of a pent-up, sort of fuel for the pent-up consumer spending. We certainly saw since the month of May a drawdown of this excess saving as per the sort of downtrend in the yellow line there that we saw in May and June this year. So there is this sort of buffers to provide for momentum in consumer spending to continue going forward, albeit at a moderating pace. And I also want to highlight this couple of charts as well. I think besides our expectation of continued growth in consumer spending to support overall GDP growth, I'm quite encouraged by the trend in private investment growth. And I think if we look, or if you recall my very first slide there, investment growth actually kind of stirred back into life in second quarter, growing by almost 6% after a somewhat stagnant first quarter of this year, and has been in decline over the past 2-3 years. I think what we are seeing right now is the impact from the realization of the surge in approved investment last year. Even for this year, looking at the first quarter approved investment plus what's in the pipeline, I think this year approved investment, while will come off from the surge that we saw last year, it will normalize to the pre-COVID-19 levels that we saw, particularly between 2016 and 2019 levels. And what is also interesting about the robustness of the private sector investment approval, as well as the numbers that we're seeing, certainly for the second quarter of this year, is a large chunk of that is driven by approved investment and realized investment in the technology sector, or the electronics and electrical, or E&E. I think that's very interesting because it does show how we are still competitive and attracting investments by both local and foreign companies into the sectors. The sector also is, and in generally have a fairly sort of a positive long-term prospect, particularly when you look at the chart on the right-hand side there, where we plot capex in machinery and equipment versus numbers of foreign workers. There has been issues of shortage of foreign workers in the country, but what is interesting, since 2021, businesses are actually responding to that issue by increasing the capex on technology, specifically to automate, to undertake more digitalization to overcome the issues of shortage of foreign workers in particular, and maybe shortage of workers in general as well. And they are certainly also taking advantage of the incentive given for businesses to automate, to digitalize, to adopt technology in the past couple of budgets. And I think towards the end of my presentation, the other thing I want to highlight here is as far as budget or fiscal policy is concerned, I think the space is fairly limited, and probably a somewhat contrarian view we have is, budget 2023, despite the talk of general election in the air, we take the view, as I mentioned earlier, will be less expansionary. It is expected to kickstart medium-term fiscal consolidation because, as per 12th Malaysia Plan, the government aims is actually to bring down budget deficit from this 6 to 6.5% of GDP we have been having since 2020 to 3 to 3.5% by 2025. So I think the process must begin in 2023, which is the midpoint of the 12th Malaysia Plan period of 2021 to 2025. And I think the need to engage in medium-term fiscal consolidation is also important to ensure that we do not see the government domestic debt busting the current ceiling of 35% of GDP. So I think this is also reasonable from the perspective that the narrative by the government has been that of fiscal reforms. They're talking about shifting subsidies from current blanket subsidies to targeted subsidies. They're talking about broadening the tax base and having a more sustainable sources of revenue, as opposed to this reliance on the volatile commodity-related revenues, as well as one-off revenue sources like cukai makmur. So I think this is how we see the fiscal policy and budget 2023 is going to shape up in coming months. So I'll stop there and pass over the session to MC Amira. Thanks.
So, Amir, shall I kick off?
Yeah, certainly. Go ahead.
Sure. Right, great. Thank you very much. And good afternoon, everyone. Thank you for joining us on this presentation in partnership with Bursa Malaysia. Let me just open up my slides and we can get going. So, Suhaimi has given you a very good rundown of the macro sort of prospects for Malaysia. My job in Maybank is to talk about the equities market side of the dynamics. And so I'm going to run you through a few slides, give you some context, and talk about what we find interesting about where the KLCI is right now and where it may be headed. But to start off, let me give you some context. So let's talk a little bit about recent history for the KLCI. And let's start, the fourth quarter of last year, which is when the budget is traditionally announced. And you saw the KLCI did have a very rough fourth quarter. I think a key measure in the budget was something called the prosperity tax, or cukai makmur, and that's an additional tax on particularly profitable companies that was implemented to sort of help the government tide over some fiscal issues last year. Now, it's not a very broad tax. Only about 250 companies in the whole country were subject to it. But obviously, these are the biggest companies, and they are very well represented on the KLCI and the market, equity market in general. So the immediate reaction, I think, was negative. You can see the downtrend there. But the market did recover towards the end of last year, as this is meant to be a one-year tax. So I think there was quite a good sort of messaging from the government towards the end of the year that it's a one-off, specifically due to the pandemic costs that the government had to incur over the last 2 years. And going forward, that kind of tax would not be repeated. And we know this kind of levy on the corporate sector is not unique to Malaysia. We have seen it in other countries or proposed in other countries as well. So this year, we should not see that repeated, and the market, sort of ended last year on a more optimistic tone. For much of the start of this year, for the first 4 to 5 months, the market was actually trading quite positively with good volumes. I think the dominant theme, similar to much of ASEAN, was the reopening thematic. I mean, ASEAN was reopening together, basically, about 6 months behind much of the developed world. But it was a concerted reopening, so that made the thematic much more powerful. And in Malaysia's case, we dismantled basically all the pandemic restrictions in place, domestic mobility as well as international mobility. So now, it's seamless. You can fly in and out of Malaysia without pretty much any COVID related checks or issues. So that was the very optimistic tone at the start of the year. But as we progressed into the middle of the year, external issues started to weigh on the market. And this is really what started, at least, as a developed market battle against inflation, brought, to a large measure, brought about by the Ukraine-Russia conflict, but also supply chain issues, which have been, long in building, but sort of burst onto the scene in the first half of this year as well. So I think the downtrend you see June onwards, a couple of things there. We did see 2 back-to-back substantial interest rate hikes by the Fed, which really soured sentiment, and that's not unique to Malaysia globally. And it really did raise expectations that Bank Negara would have to accelerate its rate increases, and it did. Bank Negara did have a surprise rate hike in June, and we expect one more by the end of this year, but certainly not to the same extent as the US. And following those 2 rate hikes by the US, the market did start to see a recovery again, as the feeling was, as I mentioned, Bank Negara would continue to be measured in their rate increases. So we are seeing a total of 75 basis points increase this year, which is not a huge issue for corporate earnings compared to the US, which is seeing a much greater quantum of increase in interest rates this year. And also, optimism that a lot of inflation indicators, as Suhaimi mentioned, in the commodity space, in the logistics space, food, energy, were starting to turn down. So we may be, approaching peak inflation. And that's where we stand right now. The index is at 1,500. It's recovered from its low of 1411 on this optimism that the worst of US interest rate increases, as well as the inflation situation, at least globally, or the inflation pressures globally, are behind us. Certainly in the Malaysia context, it's useful, and I will touch on this a bit later as well. It's useful to note that we may see some fiscal adjustments in the next 18 months, which could be inflationary, but we expect those to be sort of introduced in a staggered manner and with ample lead time. So the disruption, if any, on consumers and businesses should be quite modest. So we have 1,500 now. And the bottom 2 charts are really quite interesting. The KLCI has actually been quite an outperformer from a regional perspective. If you look at ASEAN, if you look at North Asia, in both local currency terms, which is the bottom left bar chart, as well as in US dollar terms, bottom right, Malaysia stacks up there. Of course, it's not doing as well as Indonesia, which has this huge commodities attraction for investors, as well as domestic demand attraction, or Singapore, which has really come out of the pandemic early and quite strongly. But we are doing much better than most of our neighbors in ASEAN. And a lot of that has to do with the fact that earnings have been very resilient, and I will show you a chart on that shortly. But also, a key part, and what makes the Malaysian Index very defensive or very attractive to people looking for a defensive position in the current global uncertainties, is this. So this is the KLCI composition. Top 30 stocks make up the benchmark. And you can see I've also listed out all the major shareholders of a lot of these stocks. And you can see that the shareholder backing is pretty solid for most of them. A lot of government-linked investment companies are invested in these stocks. And they have been very long, loyal, and dependable partners for the corporates in question. The thing about the Malaysian index, and it's been criticized for this before. It's a very old economy index. If you look at it, it's 30% banks, 25% commodities, which is mostly plantations, and a lot of telcos and utilities. So that was an issue over the last 2 years. But now, and we find investors are actually embracing this certainty, because these may not be very sexy businesses, in terms of growth profile, but they are dependable businesses. Yeah, the cash flows are solid, the balance sheets are solid, and there's a lot of visibility on their earnings. And I think that's a big reason why investors have gravitated to markets like Malaysia in this very uncertain times globally, because you have that dependency and that visibility on cash flows, and also dividends, which I will also touch on a bit later. That's not to say the index has been completely static. We have seen some recent entrants like Inari in the technology space. It's not been a great year for technology in Malaysia, but over the last 2 years, Inari was 40-50 in terms of market cap ranking. In this current table, it's 28 in Malaysia. So the tech stocks are starting to appear. And I think if you look 5 years down the road, you'll see greater tech representation in this index as well, and making it a bit more robust, I guess, and balanced. Now, foreigners for foreign participation in Malaysia, it has been relatively steady. If you look at the top left, share of participation in domestic trading, foreigners have always been quite dependable at about 25 to 30% of market trading. There's obviously domestic institutions are much bigger, and retail is about just slightly less than foreign. But that really changed during the pandemic. Pandemic, like most places in the world, retail really became a powerful force in the market. You can see that in 2020, 2021, retail was almost 40% of participation, and foreign participation was quite a bit less, as people became very defensive and concerned about their own markets. But we're seeing that normalizing again. Year to date, foreigners are back, not just in ratio terms, but if you look at top right, that red line, foreigners have been net buyers year to date. They were also net buyers for many months last year as well. So they've really sort of mitigated for a lot of domestic institutional selling over the last couple of months. And I think to us that's interesting, because we know for a fact that domestic institutions are very cashed up. They are cautious, especially as we head into general elections in the coming few months. But after elections, there's a lot of cash or dry powder among domestic entities, which makes us quite optimistic on the post-elections market scenario, because this money will be put to work at some point. And that's probably going to be the next leg for the market's re-rating. And everyone knows in Malaysia, domestic liquidity is massive. EPF alone manages about R1 trillion, which is about $230 billion US. And we have other sizable funds as well, like PNB Corp, which are also sitting on a lot of cash and get cash inflows every month. So that's something that we're quite optimistic about post-elections. Now, bottom left, this stat, you can read it two ways. Foreign ownership in Malaysia has been falling for quite a while. And I'll show you that in a bit later on the next slide. And in July, it was 20.2%, despite the increase in foreign buying year to date. Obviously, there is a denominator effect. The market capitalization of the market has increased at a faster pace or at a different pace than foreign ownership, which is why you see that ratio being relatively low. But the point I make is, over the last year and a bit, that ratio hasn't changed very much. We seem to have hit the bottom as far as foreign selling is concerned in Malaysia. And if you're looking at foreign selling, attention has really shifted to what was once, the darling for foreign investors, which is the fixed income market. So if you look at the bottom right, MGS and government investment issues by the government, until the early part of this year, they were at record levels. Foreigners owned almost a quarter of all debt issuance by the government. That's been declining. So that's where the selling has been most pronounced, not the equity market, because the selling there has been going on for many years and looks to have hit bottom. But it's really the fixed income market. And we can see that in a different format, the top left here, the bar chart. So it shows you equity flows and debt flows. So for the longest time, equity flows, that yellow bar has been negative for Malaysia. And you can see top right and bottom left bar charts show that in different formats. It's been quite negative. But over the last couple of, I would say 12 months, we've seen the yellow bars become more positive. But at the same time, the gray bars, which are the fixed income bars or flows, become more negative. So if we are really, going to be in a prolonged inflation environment, which is generally bad for fixed income, we could see this kind of divergence continue, where investors have become a lot more comfortable with equities, which give them inflation protection as compared to fixed income in Malaysia. And that will be good for the KLCI. Bottom right, as I mentioned, foreign net buy. I've given you the ASEAN picture here up to July, which are the latest stats. But you'll notice that for Malaysia, for many months, as I mentioned before, in the last 18 months, it has been generally a fairly positive picture as far as net foreign interest is concerned. Now, let me talk a little bit more about the earnings that we're seeing from corporates in Malaysia. I mentioned before, old economy equals a more stable earnings delivery. And that's generally the case. If you look at the top right bar chart, which is the quarterly earnings based on our coverage, and our coverage is quite synonymous with the KLCI. We cover about 110 stocks and most of the KLCI stocks. You can see that it was actually fairly stable until the pandemic. And then an interesting thing happened during the pandemic. We demonstrated a very unique positive, not available in many other parts of the world. In fact, probably not available anywhere. And that's called the glove sector. So we had stocks like Top Glove, Hartalega, Kosan become top 5 KLCI stocks in the space of 12 months because the prospects for glove demand during the pandemic was so bullish. And you can see that in the 2021 first Q, 2Q numbers, where, we're in the middle of a pandemic, but market earnings are at record levels. So that was mostly the glove story, but not totally. As I mentioned before, very old economy makeup. The banks are still making good money. Telcos, utilities, very stable earnings generators. So that really shone through as a benefit of being, in a sort of a low beta index like the KLCI during the pandemic months. Now, we've seen some correction in the last 2-3 quarters, but pretty much all of that has been due to glove earnings coming off. Yeah, the underlying market has been pretty stable. Now, let's take another look on a closer, more granular look at earnings from a sectoral basis. So we cover about 110 stocks here in Maybank, and these are all the sectors we cover. And as I mentioned before, 2022 glove earnings are basically imploding. So if you look at the core earnings growth columns a little bit to the right, it may strike you as kind of strange. We have -1% growth in our coverage for 2022. When Suhaimi just told you we have 6% GDP expansion this year, that's really glove earnings coming off by 80% year on year. If you adjust it for the glove earnings, that -1% number would be +13%. And the +16% number next year, that big rebound, would be an even higher +18% without the continuing glove earnings contraction that we are forecasting for 2023. So don't let broad market numbers muddy the waters. If you look beyond the glove sector, we expect pretty much all sectors to show improvement over the next 12 to 24 months. The improvements will be more pronounced next year, primarily because a lot of the big sectors like banks, utilities, telcos will be paying cukai makmur in 2022. So you see banks there, only a 2% increase in earnings, despite improving margins, credit costs under control. And that's really the cukai makmur effect. When you take it away in 2023, it's double-digit earnings growth pretty much across the board for everyone. And certain sectors which were loss-making and continue to be loss-making right now, like the aviation sector, still very early in the recovery. Also the gaming sector, also very early in the tourism recovery for the casino we have here. Those we expect to be profitable by next year as well, because they're showing a very nice recovery now that borders have reopened. So that's why you see this sort of really robust 2023 earnings recovery for the market. skip this one. Let's talk a little bit about historical valuations. A little bit of a point of contention for many investors. Where should the KLCI trade at? What's a fair value? There's no doubt. I've been doing sell-side research, a lot of it in Malaysia for the last 20 years, and Malaysia has commanded much higher multiples in the past. It was not strange for many investors to pay 16, 17 times for the KLCI 10 years, 12 years ago. They would just say it's the Malaysia premium, right? You have tons of domestic liquidity. That hasn't changed. We still have tons of domestic liquidity, and which is always a force pushing up, valuations. And you have, sort of a sizable weighting still in emerging market indices. And obviously, political stability was something that investors were willing to pay up for in an ASEAN context as well, which Malaysia, did provide 10 years ago. Now, a few things have changed. We're not going to deny it. Yeah, we don't expect us to revisit the 16 to 17 times valuations again. Things have changed. Earnings growth is slower. The market is more mature. The economy is more mature. Domestic liquidity is a little bit more tempered now because Bank Negara has allowed domestic funds to invest more and more offshore. So someone like EPF has invested now more than 35% of their asset base offshore, compared to less than 20% 5 years ago. So there has been this capital that has moved out of the domestic market to diversify, which is very healthy. And obviously, some other issues like our weightings in indices and our political stability premium have eroded a little bit over the last couple of years. So we think 14, 15 times valuation is still fair for the KLCI, taking into account all these considerations. And when sorry, that's 2 pages away. Sorry, I'm just going to jump ahead to this table. When you compare it to on a regional basis, we don't have that premium anymore. So we're not expensive per se compared to the rest of ASEAN, especially when you drill down to specific sectors where quality of management, returns once adjusted for ESG criteria, actually all quite favorable for Malaysia at these kind of valuations of like 14 times forward earnings. But I'm getting ahead of myself. Let me go back a little bit and talk a little bit about thematics. So, what do investors who look at Malaysia talk about with us? And, what do they want from us? There are 3 real topics year to date, at least. One is reopening mobility. How do I play the reopening trade? And we have quite a broad number of sectors which can give you exposure to reopening trades. If you look at domestic economy sort of drivers, the retail REITs like like Pavilion REIT, the malls like Aeon would be interesting to us. A retailer like Mr. DIY with a national franchise, which is also serving sort of low middle income, where there's a lot of pent-up spending happening, would be interesting to us. Construction, we continue to look at construction projects quite closely, and we've seen some big ones coming back onto the table, like MRT3, and that will serve a construction company like Gamuda very well. Auto transport, Suhaimi mentioned the tax holiday for vehicles, but someone like Burma's Auto, which has the Mazda franchise, has its own internal story. It's acquired new franchises like Kia and Peugeot, which they are restructuring. And then you have the sort of the externally facing reopening plays like the airport, MAHB, the casino, Genting, Malaysia, and of course medical tourism. So places like IHH, KPJ, our hospital chains would provide you that sort of international reopening exposure as well to medical tourism. And the second thematic is inflation. Now, inflation we can't get away from. And Malaysia is also a little bit unique. I mentioned earlier that even though we're looking at peak inflation globally, if you look at our CPI forecast from Suhaimi and team, we actually have a higher CPI number next year than this year. So Malaysia is unique in that sense, primarily because we do expect some rollback of subsidies next year, especially the petrol subsidy. And potentially we could see widening of the tax base. So something like GST most likely will need to be reintroduced. So there will be an adjustment period, I think, which could be a little bit inflationary. So the good news is when you look at the traditional hedges for inflation issues like commodities, plenty to choose from in Malaysia. We have a huge plantation sector, which has done very well in the last 12 months. Also oil and gas plays like Petronas Chemicals, Yinson are very attractive to us as well. The consumer stocks I mentioned before. But really, one sector which I think we like across ASEAN, which is a very, in a way, natural sort of beneficiary from higher rates responding to higher inflation, are the banks. And I'll show you some fundamentals of the banks just a little bit later. But things like RHB Bank, Alliance, any of them really, we are going to see a divergent performance in the next 18 months, where many sectors will face margin pressure from higher input costs, but the banks will see margin expansion from higher interest rates. And we also have, renewable exposures like SolarVest, SciPark for investors to look at, as well as the more traditional utilities like Gas Malaysia and Telecom. And the final thematic that we spend a lot of time talking about is interest rates and FX, because the ringgit, quite an emotional topic for many locals. But actually, the ringgit has not done that badly at all if you look at a broader basket of currencies rather than just the ringgit US dollar exchange rate. But the US dollar exchange rate does serve many companies well in terms of inflating their margins when they have ringgit costs but US dollar earnings. The tech space, which I mentioned before, is growing very rapidly. It's a perfect exposure for that dynamic. So things like Inari, Vitrox, Great Tech, Frontcan, very good fundamentals, very good return on capital over multiple years, and we really like that space. And of course, Petronas Chemicals, which is one of the most cashed up companies in the region. It's sitting at about 2.5 billion net cash, US dollar net cash. So, a bit of an M&A optionality there as well. Snapshot of the banking sector. So my last few slides, I just wanted to show you, the volume picture for Malaysian banks is lukewarm. Yeah, we're talking about 5% loan growth this year from 4% last year. So not a radical acceleration, but the balance sheets are excellent. So CET1 ratios, 14 to 16% on average for the banking sector. So one of the reasons we like something like RHB, 16% plus CET1 ratio, they started giving that back in terms of higher dividends. And we would expect the other banks to follow suit once the economy recovery is more entrenched. So you're looking at a 4 to 5%, a sort of yield from this sector. Bottom left shows you the massive growth in CASA during the pandemic. It's come off a bit. It's still growing faster than fixed deposits or overall deposit growth. And this sort of supercharges the margin expansion I mentioned to you before. Because when you have lots of CASA, which doesn't reprice, but 80% of your loan book is repricing, you have a very positive net interest margin outlook. So this CASA build up is really serving the banks very well. And the final thing is credit costs. So we had a lot of assistance programs during the pandemic. So many acronyms, I won't go through all of them. But the point is, we did have a sort of a freeze, a moratorium on many repayments, like many other countries. Yeah, so we're not unique. Those are all gone now. Repayment assistance loans are now in the single digits. They peaked at about 28% in the third quarter of last year. So you've seen a rapid improvement in overall system credit quality. And when you look at the NPL ratios here, we don't have an NPL problem in Malaysia. And these numbers, even though we continue to expect them to edge higher, should be tempered by the fact that the economic recovery is gathering pace. And crucially, employment is recovering very strongly. Last three slides, just where we are. I've talked about the comparison to the rest of ASEAN. Bottom table shows you how we are weighted in the Malaysian market. We do see a lot of value at these levels. As I mentioned before, the market has derated. And there are specific sectors which are showing particular value. I would say the financials are one of them. Technology as well, which has come off about 30% year to date. A lot of investor confusion there. Everyone seems to think that Malaysian tech is like US tech or Grab or C, loss making and software focused. The truth is, it couldn't be further from that. These are companies which have been in business for 20 years, very consistent earnings track records, and focus on the hardware side, part of the operating chain. So we continue to like that space. Few other things in there like healthcare, as I mentioned before, some consumer proxies like auto, gaming. We are still cautious on gloves. We have sell calls and all the glove stocks still, and they continue to derate. I think it'll be a while before we see a bottom there, given that the Chinese are now involved in glove exports in a big way. And well, when the Chinese are competing with you, it's very difficult when it comes to price competition. They have much deeper wallets, much deeper pockets. So we'll steer clear for now until we see a bottom to average selling prices for gloves. But a lot of the other sectors are neutral. Not to say we're completely ignoring them. We do see, elements or specific companies within each which are interesting to us. I mentioned Gamuda and construction, something like Farm Fresh or Mr. DIY and consumer, etc. Last two. So this is our general portfolio. We remain very balanced in Malaysia because the market right now is a bit schizophrenic. It's not all value. It can flip overnight if there's a good inflation read into all growth. So we go with both. So in the value camp, if you look at the stocks, you'll see banks and consumer feature quite heavily in our picks. And on the growth side, tech stocks, both hardware, which I mentioned the names before, as well as software, something like CTOS Digital, which is dominant in credit ratings in Malaysia, would be very interesting to us. Also, something like Aurelius Technologies, a recent listing. This is an electronic manufacturing services company, but the different thing, the thing that's unique about them is they're moving upstream, and 98% of their workforce is domestic. I think if you follow the ESG news on Malaysia, corporates in Malaysia are much more aware of ESG risks after what happened with Top Glove and Sign Plantations, etc. So these kind of companies, which are sort of insulated from foreign labor issues, strike us as deserving a premium going forward, given the reduced ESG risk. And last table from me, dividends. So Malaysia, valuations have come down. I mentioned to you that earnings are fairly resilient, cash flow is fairly resilient. The best demonstration of that is a market's yield. And if we go back to this table, you'll see Malaysia's yield in the last two columns of that table are second only to Singapore, which is a very mature investing environment as well. So at these kind of valuations, you can find plenty of good cash dividend plays, giving you a yield of up to 8% compared to the risk-free rate, of sub 3%. And they come from a variety of sectors, not just your traditional REITs, but also consumer, utilities, and banks. So that's another solid indicator of value in this market. And that's my presentation. I'll stop here. Amir, is it back to you?
All right. Okay. Thank you, Anand and Suhaimi. So because we are right on time, we won't be able to have any time to answer any of the question. So next, we will have a panel session, which will be moderated by Tan Sri Abdul Wahid Omar, Chairman of Bursa Malaysia. And he will be joined by representatives from EPF, QAP, PNB, and Khazanah. Before we begin, note that should you have any question, you may post them over at the Q&A box. Tan Sri will be able to pick them up later. Okay, with that, I'll pass the floor to Tan Sri Wahid. Go ahead.
Well, thank you, Amira. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. And very good afternoon. Welcome to our panel session on Why Malaysia. We are indeed fortunate to have with us four distinguished personalities who are heading the four largest government-linked investment companies. We have with us, first of all, Datuk Sri Amir Hamzah Azizan, the CEO for EPF. We have Dato Amirul Feisal Zahir, the Managing Director of Khazanah, with his fresh new look, all the way from Mecca, I suppose. And we have Puan Amlizan Mohamed, the CEO for QAP, and we have Ramli, who's the CIO for private and strategic investments at PNB. So my former colleague at PNB, if I may say. Now, I must say that Suhaimi and Anand had set the stage rightly for our conversation this afternoon. Now, indeed, for several months now, Malaysia has been in limelight. I guess for some of the not so right reasons, in the sense that we are seeing volume decline. The index is trading at about 1500 level, and from what we have heard from both Anand and Suhaimi, I think the market do deserve better attention from investors. So I think that's why we have arranged this panel of the top investors in the Malaysian market. Now, if I may perhaps just wind down the clock a bit over the past couple of years, it has been a difficult 2 years, obviously, affected by the pandemic. What was supposed to be a 2-week lockdown ended up with 2 years. But Alhamdulillah, we have seen the recovery in the economy from a negative growth of 5.5% in 2020 in terms of GDP contraction. We have seen our economy rebounded fairly by 3.1% in 2021, and Alhamdulillah, in 2022, we have seen that strong rebound as announced by Bank Negara last Friday, where we've seen in the second quarter the GDP growth rebounded or expanded by some 8.9%, which is the highest growth in the region, and that brings our year-to-date half-year growth to 6.9% for 2022 first half. Now, having said that, there are still some concerns about the future, the global economy in particular, given the continued inflationary pressure brought about by the geopolitical conflicts in Ukraine, for example, the continued disruption in supply chain, given China's zero COVID lockdowns, and of course, the increasing China-US tension as well. So to start off our conversation, perhaps we can revisit the past 2 years in terms of what were the focus and what were the major changes to your investment approach due to the headwinds brought about by the pandemic, and since February this year, the war in Ukraine. So perhaps I can get the biggest fund, Dato Suhaimi first, followed by Rick, Dato Feisal, and Puan. Dato Suhaimi, over to you, please.
Thanks, Rick, for inviting EPF for this session. Yes, it's been a fairly challenging 2 years. I think it's not unique to EPF, but everyone in the investing community has had to navigate very choppy waters. Yeah, and fundamentally, I think while the whole world had to adjust to COVID and ramifications that's come up from COVID, I think as fund managers, one of the key things that we had to do was to look at what do we manage from an asset allocation point of view. And I think probably uniquely for Malaysia, one of the key things to also remember during this period, EPF also had to facilitate and help its members during this challenge, because we did give access to members to access some funds to help them ride through the pandemic. I think all in all, in the 4 withdrawal schemes that we actually had, about 145 billion ringgit was actually given out to members to help them ride through the pandemic. And with the most recent scheme, I think culminating in the second quarter of this year, where 44.8 billion was actually given out to members. So for EPF point of view, the key that we've been focusing on was to make sure the resilience of our portfolio in trying to manage the cash flows, while still making sure our members also get very good returns. And Alhamdulillah, I think we had a good year in 2021 on the back of, I think, tailwinds from the whole world coming up from the lockdowns from pandemic. And it helped facilitate a very, very strong year from an equity point of view. Unfortunately, this year, I think we've seen a slight reversal of that because of the challenges from a geopolitical point of view. And I think the era of cheap money has also changed quite a bit, where central bankers have also started to tighten up with interest rate rises. Yeah. So the art that I think all fund managers are trying to do is managing with ever-changing volatility. And for us, what keeps us focused is actually our strategic asset allocation, being very, very clear and moving along that line and keeping it within the risk tolerance that we have, so that we can always keep our returns within the range that we believe the returns should be at. And a good governance process along that line to make sure that we respond well whenever we're hit with any changes. At the same time, while all this hits the system, we cannot also ignore opportunities that come up and being able to be very fleet-footed to look at where opportunities open up and taking them up. And I think from EPF point of view, one of the key focus that we've been looking at is the real assets in actually moving some funds into our PE investments. Yeah. And that has been quite good in terms of diversification of the portfolio and continuing investments from a diverse basis, so that we are a bit more robust overall with a balance both domestically and internationally. And Alhamdulillah, I think, Tan Sri, we've managed through this period. And I think having that clarity in the SEA gives us focus in how we manage the portfolio.
Well, thank you, Dr. Sri. Now, I must say, as someone who relies on investment income from EPF, thank you so much for 6.1% return that you give us for the conventional and 5.65% for the Sharia version. So, Rick, so your perspective on how investing has been over the past 2 years compared to pre-COVID in PNB?
Thank you, Tan Sri. Thank you for having me in PNB here. I think some of the themes that Dr. Sri Amir talked about resonates well with us. So we essentially, over the last 5 years, have been trying to establish a strategic asset allocation, and as part of that asset allocation is to diversify both, geography and also asset class and also segments. That continued for the past 5 years, and I must say during COVID, we continued to deploy into international public equity, into real estate, and into private equity. Now, what the shift during COVID, I would say there are some differences. For example, we were a lot sharper in terms of some of the themes within, for example, private equity and within real estate. I'll give you an example. So, back in 2018, 100% of our real estate portfolio outside of Malaysia was in London offices. So we knew that we had to diversify into different geographies and different segments. And we thought, logistics, given the e-commerce tailwinds and a lot of the mega trends, would be a good place for us to go. So we invested into logistics during, throughout COVID. And actually, more recently, we've been with higher convictions going into that sector, because with disruption from war in Ukraine and supply chain disruption, what happens is a lot of companies, instead of doing just in time, they now create a lot of slack in their inventory. So the demand for things like warehouses and logistics is going up, and the whole trend around e-commerce and all that is still continuing. So we are strong believers there. The other thing in things like private equity is we invest behind themes like automation, as I think Suhaimi and Anand talked about, labor shortages. Automation and reducing the dependence on labor is a key theme. So we do invest into things like automation, enterprise software, healthcare, and so on within the PE space. So during COVID, we continue to invest into those sectors, but the conviction in subsectors becomes a lot more pronounced. I think the second big thing is actually the focus on sustainability has only accelerated. And I'm embarrassed to say this, but pre-COVID, when I met fund managers overseas, they will inevitably have a section that talks about ESG and their approach. And I'm like, okay, let's not spend too much time on this. Let's move on to the real things like, how you generate returns and where you investing and so on. But I think right now that focus on ESG becomes a key part of value creation. And now when I go and talk to funds outside, I spend a lot of time looking at what is their approach to sustainability. And PNB itself earlier this year in April announced our own commitments, 10 commitments to sustainability. I guess the third shift that happened during COVID is we had to look at a lot of our underwriting when we underwrite new deals. And actually a lot of that change happened in the last 6 months. So because of the increase in interest rates, and the question that people always ask is, can you expect multiples to continue to cap rates to continue to contract, or can you expect multiples to continue to be elevated? We had to relook at a lot of the underwriting that we did to make it a lot more robust. And this is still a work in progress, because when you talk to some people, they say yes, logistics cap rates will always compress because it's always going to be in demand. But if you are an investor that needs to manage risks, you will build in scenarios where you say, okay, I don't think the world will remain so as such. And last thing I would say is similar to a lot of funds out there is digital becomes a big lever that we had to use. Tan Sri, for the last 20 years, we did something called Minggu Saham. That was a physical event. We went from town to town. 2020, 2021, we had to do it digitally, Minggu Saham Amanah Digital. And that was new for us. How do you reach a digital audience and do an event fully digitally? We also had to tweak how we went to market, eKYC, the app. We had to tweak the app to make sure that it is compelling. So I would say that the big thrust of what we do, investing and making sure the portfolio is diversified and so on, remain the same, but we had to do it in a sharper way, and also to look at sustainability, relook at underwriting, and also digital as a theme.
Well, thank you, Rick. Dato Feisal.
Thanks, Sri. Thanks for having me. Actually, Khazanah's a bit different, I would say, from some of the other panelists in the sense that we're not really market players, but in Malaysia we have substantial stakes in our companies that are listed here. So, the focus areas that took prior to or post pandemic or during the pandemic, I think was one of three things. First of all, value creation. Now that period was a period where we could actually do a lot more work on trying to create value such that we can actually capture the market later on. So for example, M&A activity. I know this, some of the work happened a lot, even before the pandemic, but we supported mergers such as the Digi and Celcom transaction. So that's out in the market already. One of the things that we were trying to work on is to create one aspiration is to create a sustainability champion. And within our stable, we have 100% owned Senviro, which does scheduled waste management as well as solid waste management. And we worked on bringing in a strategic investor where they came in to acquire a 30% stake. This is SK Ecoplant. And that really allows the management team as well to gain that international experience, international level. So again, we're busy creating value. I think the other thing where we created value, and this is where we introduced Farm Fresh to the market, and everyone saw that as well. And of course, we have a few more things in the pipeline, but that was one of the focus areas, not being a market player, but being, before, where we spent most time on. The other thing, perhaps less so for my colleagues here, my friends here on the panel, is we had to deal with the sectors that were severely impacted by the pandemic. And I'm referring to the airline as well as our resorts. So for those companies, we had to come and support either a debt restructuring effort or really injecting capital into those companies to really weather the storm. It's actually it was perhaps the most difficult period for those industries ever. So, that's something that we did work very closely with our investee companies. And I'm glad to say that, things are a lot better than it was before, and really positioning it more for growth more than anything. And the third thing I would say is quite similar to the other funds, EPF as well as PNB, and that is being disciplined to make our portfolio more resilient. So rebalancing the portfolio in order to make it towards our strategic asset allocation. And why I say discipline is because, back in 2021, we had private equity investments, direct investments, which achieved, it was already mature. It was already time that we should exit, and we really focused on exiting that. So in 2021, a lot of the international investments were realized, and when you look at some of these tech-related investments, we were actually, it was good that we were disciplined because the prices, of course, are very different today. And of course, what we will be going forward is continuing the same thing, creating more value in our private investments, in our existing investments, and also continue the rebalancing of our portfolio.
Well, thank you for that, Dato' Feisal. Now, you mentioned about Farm Fresh, among others. So thank you for bringing them into the market. And we hope to have more coming, and we'll talk about that later today. For Nick, your perspective, please.
Thank you, Tan Sri. First of all, I'd like to thank Bursa Malaysia, Maybank, and Tan Sri for having Co-op on today's panel session. Definitely, it is timely for us to speak about impact of COVID-19, right? Particularly on institutions like us. It may seem cliche, but it was also a black swan event for us. It was definitely challenging during those 2 years. But having said that, we were fortunate to already have our structures in place. So Co-op SAA, Strategic Asset Allocation, was already packed down. And we have an amazing team members who steadfastly continued to invest and take opportunities. They took opportunities during the downturn. So Alhamdulillah, share, Tan Sri, that during the pandemic in 2020 and 2021, Co-op grew in fund size from 147 billion ringgit to 159 billion ringgit. And this is after assisting with pension payment to the tune of 10 billion ringgit. So our gross growth for those 2 years was actually in excess of 21 billion ringgit. And Co-op's net income for those 2 years were 19 billion ringgit. This is more than double compared to the 8 billion ringgit that we achieved in the 2 years prior to COVID-19. So together with my fellow peers here, I could hear that, we certainly put through with some decent results. So I think this was achieved only because we have been continuing with our capacity and talent capital investments in Co-op and also the other institutions as well. So otherwise, I don't think we would have been able to achieve and withstand such unprecedented storm that came our way. And also, I think from our perspective, these are basically the fundamentals that we want Malaysia to grow better in the future: human capital, the right training, robust investment infrastructure that includes appropriate SAA, using correct risk appetite, for example, definitely crucial for institutions of our nature. I think we would have floundered if we did not have such structures in place. Just to also share, we are currently in the midst of reviewing our SAA to take into consideration the long-term macro changes for our capital market assumptions, because they are changing quite fast. One example is as simple as that kind of inflation rate, whether or not this heightened inflation rate, right, cost of doing business and all that would be increased over the next few years. But regardless of the different investment approaches, discipline and proper assessment, I think I heard that from my fellow panelists just now. So these are the factors that definitely are crucial for us to ensure that the sustainability of performance will continue in the future. Thank you.
Well, thank you, Puan. It's very encouraging to hear the progress. Now, one key development during the pandemic was the GLIC mandate recharge or transformation program that was launched back in August last year. Essentially, it's a medium-term reform agenda meant to be until 2024 for GLICs to ultimately boost Malaysia's longer-term prospects and resilience, and focusing on good governance for sustainable growth, socio-economic inclusivity, and environmental sustainability. Now, perhaps as we come to the first anniversary of this program, I think it would be good to understand how things have progressed. So maybe we can start with some thoughts from the sovereign wealth funds as defined under the program, meaning Khazanah and Co-op, and then move on to the institutional investors, EPF and PMB. Dato Feisal, maybe you can start first. Thank you.
Thanks, Azizan. I'll share with you the areas that we worked on very, very closely. There's many aspects. I think the two areas that we actually put a lot of effort on would be looking at new growth areas or catalytic sectors. And this is done via our fund. We created a new fund called Dana Impact, which I'll give a very brief update. The other area is sustainability, but that's like there's many things that related to that. Maybe we can talk about that later. So I can maybe share a bit about Dana Impact. Now, it's the fund, or the approach towards creating the fund was actually endorsed and approved by our board at the end of last year. So it's fairly new in a way. But the long and short of it is it's really looking at trying to see how we can actually spur new growth areas, but also looking at how we can improve the resilience for the country. So think of it as an offense and a defense. Offense, looking at where we can actually catalyze new growth, and defense, where we might want to participate in that can actually improve the resilience of the country. Now, the other thing is the themes. Now, the themes that we're looking at for our impact fund would be along digital, and here we talk about creating a digital society and a technology hub. Climate resilience, that's another important aspect. Food and energy security, that's topical for all countries, and I think that's where it's about defense, right? Food resilience. Health and education, and also decent work and social mobility. Now, these are very broad areas, and when we look at the fund, we've allocated 6 billion over 5 years. So, in the scheme of things, and given the industry, it's not a lot. So, what we're hoping to do in trying to make those investments is to make sure that we try to crowd in people. So again, when there are areas where it makes sense for the country to either to invest, it may not be an area where people invested before because perhaps it's too risky, and in the area where it's a bit too difficult. This is where we're using ourselves, where we are a long-term investor. We can be a bit more patient in terms of returns. We can actually use our influence in terms of policy making as well in order to partner people to perhaps de-risk those investments. So these are the areas that we are doing. Now, a lot is being done, by the way. A lot is being done, but I think when things come out, we will share to the public. Right now, not yet. But there is one thing I'd also like to mention. The reason why we're doing this, we're not just looking at a financial return or it's not like a pure investor. There's also the societal impact that we look at. And the difficulty here is, how do you measure societal impact assessment? And what we've been doing, and this is something that I can share a bit more, is when in making investments, we're not the only ones, by the way, that make impact investments. There are more commercial impact investors, TPGs, KKRs, impact funds are created. So we've actually come up with a framework in order to look at impact, and we've worked with or consulted with the likes of Global Impact Investors Network, BlackRock, TPG, Bridgespan, KKR, and a few others, that we've actually been speaking to look at our framework and see whether it's consistent. And what we're seeing is there's a convergence in terms of that way in order to measure it. It's just that we have to be tailored to our own journey for impact investing. And I think what we hope to do is, when we actually come up with these opportunities that we participate in Dana Impact, we will also share this framework that we're adopting in order to measure the societal value. We call it internally as Project Samara, by the way. So that's something that we'd like to do, and we share with other impact investment organizations within the country. And hopefully we can, that's something that people can be more aware of. We can refine it further, and we can share the framework. So that's the main focus that we've been working on since the beginning of last year. Sustainability is the other one, which there's actually a lot that I can talk about, but I'll allow maybe Nick to talk first, and we can talk about sustainability later.
Thank you. Puan.
Thank you, Tan Sri and Dato Feisal, for that. I think Pokoko was definitely timely for Co-op to rethink and reset our plans ahead, given all the learnings that we took during the pandemic and of course the subsequent supply chain disruptions and so forth. And most recently, Co-op launched Teras 5. Teras means core, for those who don't understand Bahasa. Co-op has grown fourfold since our inception 15 years ago, and today we are in over 40 countries. So we mostly cannot afford to rest on our laurels. So that's why we launched Teras 5. It is actually for the purpose of strengthening our foundations and to enhance our processes and gear us in the right direction as we prepare ourselves to basically capitalize on emerging opportunities as a result of the volatilities that we had undergone the last few years. Volatility obviously is not going to go away. So we hope that when it reaches an equilibrium, we would be ready to capture on those opportunities. Just to share a bit on Teras 5, it is a 3-year program based on elevating 5 enablers. So we have structure, governance, people, processes, and digital. And we will execute using 8 work streams. It includes the typical ones like the org structure, enterprise, investment, retirement services, digital, people and culture, corporate services. Of course, we cannot afford to but improve further our risk governance and oversight. So if you look at all these different work streams, 2 stands out to be the core focus as our frontliners, the investment and the retirement services. And the rest we will utilize to be functioning to support the growth that we have planned in the years ahead. So in essence, there is always room for improvements, be it in governance, investment strategies, and most importantly, talent capacity building. I keep talking about talent because I think for us as an organization, our asset basically is the talent, right? The assets belongs to the government, to the pensioners, but for Co-op as an organization, talent is crucial for us. So it is so crucial for us to get the right talents, and we must ensure that these talents remain within Malaysia. It's okay to have the talents kind of, rotate amongst the 4 institutions here, that's fine. But we must maintain them onshore to make sure that, they help us to continue to be sustainable going forward, and so that all of us can compete on a global platform in a much stronger footing.
I'm glad you mentioned the word talent, Nick. Indeed, I think there's a need for us to grow the number of talents among the investment professionals, I'd say, and in particular the CFA charter holders. And it's something which I hope we can work on together as an industry, including the capital market industry as well. So thank you for that. Dato Sri Amir, from EPF's perspective.
Well, when we looked at Prokoko, a lot of the effort that EPF was spending time in the past was really focusing on ethical investing and governance. Yeah. And of late, we've been spending a lot of our time on the sustainability journey and how to sustainably invest in a different form. And one of the key things that we're very, very conscious is, apart from EPF itself actually doing that, is actually creating a mechanism that people understand the conversation language that EPF actually has. So we'll talk a little bit about sustainability in the next segment that we'll be spending time on. But what we wanted to also do is not just EPF investing in this space, but allowing a wider community to come in and invest. So for EPF, as you all are well aware, we do have our members' investment schemes, yeah, whereby members who have reached a certain amount of savings are allowed to withdraw a certain amount to invest under their own accord and manage their funds in that particular manner. And what we were looking at in facilitating a development of much more vibrant sustainable space is to pre-qualify a number of unit trust managements who have mandates in the sustainable space, so that our members can also choose to invest in that space. So it creates a little bit more volatility, strength, and liquidity in that space. So the market becomes much deeper than it actually does without support. Inshallah, by the fourth quarter of this year, we'll be announcing the expansion of our mandates that are allowing members to invest by themselves through our members investment scheme to support the sustainable journey in that sense. And I think that's one of the newer nuances that EPF is doing in terms of strengthening ownership by members in terms of where they want to put money in, what type of investments they want to do, but guided in that space so that we have a fair return reward mechanism and stuff put in. As we do that, we are also conscious that sometimes EPF has very large mandates that it goes out and invests by itself. What we may want to do is actually offer the member the opportunity to partner EPF while it invests from a private mandate point of view. And we think that we'll be able to do that in next year, where private mandates which have bigger funds allocated along that line, we can allow members to come in together with us if they choose to invest from a much more sustainable investing space horizon. I think by doing that, I think Malaysia will commit a lot better in terms of creating much more vibrant sustainability support financing for the sustainability space. And that's one thing that EPF is doing in this Perkuko journey.
Thank you, Dr. Suhaimi. Rick?
Yeah, so I think firstly, I'd like to say we do welcome Perkuko, especially the first outcome, which is essentially to sharpen and clarify the mandate. As you started, Tan Sri, you have sovereign wealth funds here and you have institutional investors here. We all have very different objectives and mandates, and clarifying what we do is very important. For PNB, the way we participate in Perkuko is manifold, but I'll emphasize and focus on one. We believe strongly in our role as investment stewards. So we are, 60% of our portfolio is domestic equities Malaysia. We, control a lot of companies and have board representation in a lot of companies in Malaysia, and we believe two things in terms of adding value as part of Perkuko. One is the entire governance. And I know governance is used a lot, but the way we think about governance and we're trying to up our game is we are a lot sharper now about being transparent about how we will vote at AGMs. So we explain why we will vote, we explain what we look for. So our voting guidelines, our stewardship framework is all online so that companies are aware and understand our priorities and why we invest in those companies. Secondly, a lot of governance and change happens in the boardroom and through management. So we spend now disproportionate of time looking at the boards that we have. Are they the right skill set? Do they have the right dynamics? Are they asking the right questions? And we now have both an art and a scientific way of doing it, but we are putting in place a framework in terms of how we assess the boards that we have. So it's not only that we want having prominent people, we want the dynamic to be done correctly, and we want them to be clear. What does the company need? Does the company need status quo? In which case the board has to be structured for status quo. But if the board or the company needs to be transformed and pivoted, we need to have skill sets and members who can help in that transition journey. So that's all on governance. The second thing that we now have in place in PNB is we call it our what we call a strategic investment playbook. So in the past we have 50-60 companies where we control at least 10% or 1 billion ringgit investment in. We held it. The objective was usually a dividend or capital growth. But right now we took a hard view at the portfolio and said, hey, which one of these we want to keep for the long term? Which one of these we think we might not want to hold on to it, and which one of these we want to keep, but there needs to be something has to happen in terms of transformation. So that we call it an SI playbook. It is a sector by sector, company by company playbook, and in a way it forces our investment professionals to be clear what we want out of these companies, and if we don't get it, we either have to create escalations around engagement with the board, engagement with the companies, or at the very end of that escalation, we say we can't do anything and sell. So we are not, we are a big part of the Bursa. I think Anand was saying a lot of us invest in that, but I think we are going to start being, I wouldn't use the word activist, but we're going to start being a lot more thoughtful in terms of engaging with companies and be clear what we want out of it. And we will use investment stewardship as the means to extract value, either having, being clear with our boards what we want from the companies, or at least from the investment side, doing operational or transactional VCPs to get the value out of these companies.
Well, thank you, Rick. Interesting you mentioned about the options on actions. So naturally, as Anand mentioned, collectively, the four of you control or have got significant influence, voting influence over many companies. And I guess where things are not moving well, despite the stewardship, so perhaps some change in the board level and the management will augur well for the respective organizations. Now, I've been looking at the Q&A box, and there have been some questions already on sustainability. So maybe that's actually where I would like to go into next. Now, indeed, sustainability, which is one of the agenda under the GLIC transformation program, is a key principle in building resilience and supporting value creation. Now, we believe that the pandemic years have not derailed our sustainability efforts. And in fact, sustainability has elevated to become one of the key focus for us at Bursa Malaysia. Now, our goal in sustainability is clearly spelled out in the roadmap 2021-2023 that we launched early this year, that covers the aims for ourselves as an exchange, our public listed companies, and for the broader market. Now, our sustainability roadmap focuses on three main strategies: product expansion to grow values for our market participants; secondly, on ecosystem development to create a more conducive and competitive marketplace; and third, capacity and capabilities building through our people, culture, and technology to future-proof our business. Now, I must say that our roadmap outlines exciting new opportunities for our growth trajectory and to capitalize a vibrant marketplace, inshallah, God willing. I'm so sorry that I just couldn't resist the opportunity for a quick plug or a pitch for Bursa Malaysia. Now, moving over to our four panelists here, perhaps you can share with us your sustainability journey, roadmaps or targets, and also what are the challenges foreseen. So for Datuk Seri Amir, EPF started its transition journey to be a sustainable investor in 2021 and has identified two sustainable investment targets. Firstly, a fully ESG compliant portfolio by 2030, and secondly, a climate neutral portfolio by 2050. Your perspectives, please.
Thank you, Tanshi. Actually, EPF has been on the sustainable journey for a bit now. In 2020, we announced our overarching goal, which was to become fully ESG compliant by 2030, which effectively means that our portfolio must meet EPF's core requirements under its sustainable investment policy. And by 2050, to become a net zero GHG emission portfolio, which is a fairly large role. Yeah. And earlier this year in March, we announced our sustainable investment policy so that our investees are actually quite clear. What do we mean by these targets and what is our expectation out there? And fundamentally, in the guiding principles that we set out, we wanted to make it very, very clear that everybody understands from an EPF point of view, how would we actually effect our movements towards this direction. And the most important element to that is as what Rick had actually said just now in terms of the stewardship policy that we actually have. So how do we guide companies to actually move directionally in the area that we want? Most people actually know that from an EPF point of view, we apply a negative screening mechanism whereby we put the investment that we're trying to walk into under an ESG lens, and we look at it from an environment target point of view and so on, governance point of view, and ask the questions, are we concerned with anything along the way before we actually take the next step of investing? But once the portfolios has actually come into a system, how do we help the organization as they evolve? So they actually move into the space that we think directionally they should be moving in. So the sustainable investment policy that we put out actually lays out our stewardship framework and be very crystal clear in terms of the areas that we'll be looking at and our expectations from our investing policy, and setting out what we call core requirements that we expect are things that the investing company should exhibit to remain within the investment of EPF. Yeah. And a roadmap that directionally by 2030, what do you expect you to get to? And by 2050, how do you want to get there? Yeah. And the role that EPF will be playing is not just sit outside and then invest or not invest, but actually our role is actually to help the process of educating along the way, helping the investing company navigate, because we see a lot of organizations, and share best practices as we can. Yeah, but also setting expectations from a shareholder point of view, so that the organization can adjust along the way. We don't think ESG is something that you can embrace and say, today with this, tomorrow we can't turn the switch off overnight. But what we really want is investing companies to embrace the movement, yeah, and then plan, structure, and move towards that directionality that will get them to where we want them to actually end up. But ultimately, I think as what Rick also put on the table, one of our most powerful tools that we as a shareholder actually have is our voting guidelines, where we tell the organization, look, if we're not seeing this, we can take steps in this particular manner. We can influence you by talking and sharing good practice and so on. We can raise motions in your AGM. So what was a fairly quiet and passive shareholder will begin to be a little bit more noisier as we move on. So we've also embraced the same thing as Rick has said. So for example, beginning this year, EPF publishes its voting decisions. Yeah, you can find it on EPF website. For every single AGM we attend, we publish how did we vote. And when the vote is negative or abstention, we explain the logic of why we voted that particular way. It is our expectation that by next year, we will be publishing our voting decisions in advance or before the AGM. Yeah, and this is part and parcel of us actually laying out what our expectation as shareholders are, and actually guiding the investments along the way. However, investing companies, of course, are free to take their own decisions. And if at the end of the day, the alignments do not fit where EPF is, the last resort that EPF actually will have is actually to decide whether it remains invested in the entity or not. But we believe that in most instances or not, a good, open, frank dialogue will find a way that we can find alignments along the way. So it's a much more measured process. So I think that whole journey is about stewardship and getting the movement and pulling everybody along into that same direction. And I think for EPF, two key core elements that we put out there is our climate change expectation and our workers' well-being expectation. And we've done the same thing in terms of breaking down expectations for investor companies. And I think that will help by providing clarity.
Well, great initiatives indeed, the three. For Rick, well, PNB launched its sustainability framework in April this year, where you aligned 10 commitments under the 3 pillars of ESG. Maybe you can highlight a bit more.
Yeah, if I can get the organizers to flash the slide. I'm not going to go through all 10, but I wanted to highlight a few things. One is we are at the start of this journey. It is a multi-year journey. We don't have all the answers, but we are committed to achieving these 10 things. But I wanted to talk a bit about a few things. One is I think we made good progress, and I'll highlight number 9, transparency in voting. I think Dato Sri Amir talked about publishing our voting guidelines and also how we're going to vote. PNB right now, at least for our core and strategic companies, these are roughly about 50 companies, we publish how we will vote ahead of the AGM or EGM. So 5 days before, we publish it on our website. You can go and look how we are going to vote. And the reason why we do this is it gives the opportunities of companies to proactively engage with us. If they think we misunderstood the resolution and they want to engage with us and convince us to vote yes, they can give us the opportunity. They can have the opportunity to do that. Secondly, it also transmits how we tend to vote, and also if we deviate or vote no, we will explain why. And lastly, it could also give opportunity for minority shareholders to engage us and say, hey, we feel strongly about XYZ, why don't together with us you vote accordingly? So that is why we feel strongly about 9. So first message is we are making some progress. Secondly is some of these commitments are easy to make, but not so obvious how you want to go out and do it. So I'll highlight number 5. So labor rights policy paper, we took inspiration from EPF's workers' well-being policy. So there are 6 areas with high-level statements. I think the high-level statements in itself not difficult to make, but the stance of how you want to implement it can be very different. So if I understand correctly, the way EPF does it is they publish it, they publish the expectation, they even publish best practice. Companies are expected to understand it and comply with it, but if they don't comply, then EPF obviously comes and engage with them. Now, the question for PNB is that sufficient? Because for some of these companies, we own 50%, we have 3 directors or 3 board members. So we're thinking about, are there areas where we need to do more, i.e. go in and shape policy, in plantations, for example, or in construction or real estate? And do we even take the next step and invest behind it? So if you feel strongly about workers' housing and all that, do we start investing in real estate into that asset class in order to see change? And then I highlight maybe on the environment side, net zero, enterprise net zero portfolio. This is, as I said, commitments that are easy to make, but not trivial to implement. So right now, we are in the process of trying to firstly inventorize our exposure, and I guess inventorizing carbon exposure in public listed companies is a bit easier. But how do you do that for asset class like sovereign bonds? So what is the underlying exposure do you calculate? The same goes with fund investment in private equity. So how do you actually calculate that? So that's one thing that we are going through right now, trying to figure out how we actually calculate it. And I guess to Dato Sri Amir's point, what is the stance for new investment? So EPF took the approach of, I have a negative list. For us, we see the benefits of a negative list, but we also can do things like, do I start having things like a carbon budget, right? Moving forward, I have X amount of tons I want to spend on, I need to allocate it properly. Or do I can even take a step further and do things like internal carbon pricing and then adjust project economics to reflect that. So those are things that we're trying to figure out how exactly we do that. But I think, Tan Sri, you mentioned, ultimately, the pain points, at least in Malaysia, are known. The biggest exposure a lot of the companies here have is probably the utility exposure in carbon. And as a shareholder, as a group, I think it's important for us to be clear what we expect from these companies. Because the last thing you want is a company hearing message X from Khazanah, message Y from PNB, and message C from EPF, and they get confused what they should do. So I think as a group, we need to have mechanisms to align our own means, our own initiatives. And today we do that via things like IIC, Institutional Investors Council, where we go in and align on certain things, priorities that we want, and at least the companies hear a concerted voice in terms of what the cliques want. Thank you.
Well, thank you, Rick. Indeed, you mentioned IIC. We just had our annual engagement with them last week, led by Puan Rohaya, the CEO of EPF. So I think that's certainly a good platform. Monique, your thoughts?
Thank you, Tan Sri. Please do permit me to spend a bit more minutes on this subject matter that is very close to co-op, and maybe share with you an audience in terms of our ESG framework structure and why we do it. Of course, it always starts with the why, right? Why is the most crucial part. And at co-op, we believe that the best practices for ESG can only contribute towards generating long-term returns for the fund. So within co-op, we have our internal sustainability framework that we refer to, which is not too different from what has been shared by Mr. Rick just now. And this framework basically guides the overall ESG governance within our organization. So it is a dynamic kind of document that we enhance regularly to keep up with the best practices out there. So I think I've shared this before. It is definitely a journey for us. I think Dato Suhaimi just now mentioned that as well. It's not static. So to break it down, at corporate level, we developed this corporate level ESG guidelines since 2016. And at investment level, we have developed ESG policy that has recently been enhanced further to incorporate basically our stance on two additional aspects. Maybe I can share these two aspects. The first one is not to invest in companies that are unmitigated in violation of widely accepted ethical norms, standards, and laws with regards to human rights, labor standards, environment, as well as anti-corruption. And the second aspect is not to invest in companies that operate in unsustainable manner with severe and irremediable damage to biodiversity, ecosystem, climate, as well as community. So you can see that these two aspects basically cut across all industries and basically also kind of mark whether or not they want to progress ahead or not. So if they want to proceed positively on this journey, we will continue to hold their hands and assist them on their journey. So we demonstrate this also very clearly. I think that the Suhaimi mentioned just now via our voting rights and our engagements, playing that stewardship role. I think these two are basically key drivers to reflect what we expect from our investee companies. And should our investee companies not display their commitments for the betterment, that means it is a journey of their ESG practices, co-op will not hesitate but dispose that investment immediately. I think our action speaks louder than words, and we have done so quite publicly as well in the past. Co-op, over and above that, we also have our dedicated responsible investing unit since 2016 to improve ESG ecosystem in Malaysia. So besides providing input to regulators for the sustainable blueprint, we also continue to be active, very active as far as our stakeholder engagements are concerned. And we definitely, I think that's what you mentioned just now about the sustainability, the comprehensive sustainability framework into corporate measure as shared by you just now on Bursa Sustainability Reporting Guide. So we will very much welcome that. And also, we also applaud Negara for launching the climate change and principle-based taxonomy, and as well as the Joint Committee on Climate Change, co-chaired with SC, for releasing the Task Force on Climate-Related Financial Disclosures application guide for Malaysian financial institutions. As we are all aware, co-op as well as other institutional investors here, we have significant investments in FIs. So we are pleased to note that the much effective nudge by the central bank for the Malaysian financial institutions to do their part as far as addressing climate change. On top of that, Tansi, maybe I could also share that co-op is a signatory to Malaysian Code of Institutional Investors, as well as a member of ICGN, which is the International Corporation Governance Network, as well as ACGA since 2015. And we are also a signatory of UN-backed PRI since 2018, where we have, Alhamdulillah, achieved 3 A's, including 1 A+ for strategy and governance. And over and above that, we have also won in the past Asian Investors Institutional Excellence Award in 2018 for our stewardship role. And recently in 2021, we ranked top in Malaysia for Responsible Asset Allocated Initiative Index. So Alhamdulillah, I mean, I think that basically kind of encapsulates that ESG for co-op is not just a buzzword. we do walk the talk as far as ESG matters are concerned.
Oh, thank you, Puan, on that. Well, I must say that all the efforts you're putting in are getting attention by the PLCs. So, for example, in our engagement with the many PLCs, they're actually quite, I suppose, concerned about the voting transparency and the impact on their reputation. And therefore, although in some cases they were able to carry the vote, but because of the dissenting views from the GIC, they are paying attention. So I think for future initiatives, they will be consulting, I think, a lot more with the market, making sure that they're able to convince all the shareholders to vote in the positive or desired manner, if I may. Now, we have about 20-25 minutes to go. There are a couple of areas which I would like to cover. One is in respect of technology, and the other one is in respect of our strong financial system as articulated by Anand earlier. Now, on technology, perhaps we can look at some of the broad policy directions and progress in the past 2 years that provide the ecosystem to support the next leg of growth for the country. Now, for example, we have 4 in particular. The Malaysia Digital Economy Blueprint that was launched in February last year to boost economic competitiveness through digitalization. Secondly, we have Jendela. This is my favorite, I would say, which is a comprehensive digital infrastructure plan that prioritizes strengthening the country's fixed and 4G networks, and it primes the nation's transition to 5G, and which is very much into its last leg for phase 1, ending this year. The third is in terms of the 5 digital banking licenses that were given out by Negara in April this year to further advance financial inclusion. And the fourth is the National Energy Policy 2021-2040 that's expected to be launched later this month to boost investments and advance our sustainable development goals. Now, to the panelists here, maybe perhaps we can get Datuk Feisal and Puan to comment. Where do you see most investment opportunities, and how and where you play a pivotal role in advancing the country's digital economy and sustainability agenda? And do you foresee any policy headwinds ahead? Datuk Feisal?
Thanks, Dato. First of all, I think when you look at the space that Khazanah invests in this area in Malaysia, it's actually earlier before it goes public. And we've been investing through private equity, either through venture funds, or also directly as co-investing, or even investing directly in early stages of some of these companies in those areas, whether it's digital and technology, etc. So what's interesting is in the area of digital, here we talk about technology companies which would benefit from the Malaysia Digital Economy Blueprint, some of the digital infrastructure. That is an area where we've seen companies actually coming out and going for pre-IPO where they're actually very, very valuable. So that's something that we saw early in 2011, 2012. We've participated through venture funds that have been seeded, and some of them have actually grown. Some of them are in the mid 2015s, so that's when they started. But I think there's a few things I'd like to note here. While that's something that we will see more and more of as it gains momentum, you might say that you asked a question about policy headwinds, some of the things which would make it a bit more difficult for them to hit the market. And I would say there's 2 things, speaking to some of them, generally 2 areas. One would be funding at the early stage. And this is making sure that the risk capital, in order to fuel them at the early stages, up until perhaps Series D or Series E or pre-IPO, is consistently there. And why I say that is because sometimes, entrepreneurs, they want to do their work in business rather than chase for money. So having that group. And in the country, in Malaysia, we do have them. We're having more of them, but I guess that needs to be coordinated better. So that's one of the so-called headwinds, which I think we can do better. The other thing is talent. And that is a problem everywhere around the world, getting the right talent in order to spread the growth. And we are also looking at this very seriously from a dana impact perspective. So both from a dana impact in terms of talent as well as funding. So that's something we're looking at closely in order to allow more and more this momentum to actually gain a lot more. So that's an area where it is a investment opportunity. But I would say that's more mature than my next point. My next area, which I'm saying I'm about to mention here, is something which is perhaps a bit more recent, and that is on sustainability. So what we are seeing is naturally, we just talked about it. We had a question about it. A lot of companies realize this, and they do realize this, and they do realize that they need to pivot. You would have heard a lot of news coming out from Nasional, for example, which is one of our, we're a major investor there. And they're also making a lot of changes themselves. You've heard Petronas, for example, also seeing that as an area where you want to move, they want to move quickly. And we invited them for our Khazanah Megatrend forums last year. So when you have big companies such as Petronas or Tenaga willing to move and pivot fast in the area of climate resilience or energy transition, then you're naturally going to find opportunities along the supply chain as well, right? So that's an area that we do see something which is gaining momentum, the whole infrastructure around energy transition. But, then it comes back to policies as well, right? So it comes back to policies in terms of how do we support that transition faster. Now, I would say that I'll just talk about electric vehicles, right? Perhaps some of the policy can be better coordinated in tackling this whole area, because it's not just about the vehicles, but it's about the infrastructure in order to create that network of charging points. Otherwise people get range anxiety, right? They don't want to drive their electric vehicles because they don't know whether they need charging. So it's coming out of that. And you just have to look at our neighbor, for example, in Thailand. They have made a policy that internal combustion engines, new internal combustion engine sales will be stopped from 2035 onwards. So that's EV fully. They have support in terms of supply side, demand side, incentives everywhere, including the charging points as well. So I think, that's where, when you look at policy headwinds in a market where it's really exciting, it really is, because we can see the energy transition, a much needed sector for this country. And we can see the funding that will attract it. And most of the funds, by the way, when we talk about sustainability, it's always about, let's not invest here, let's not invest there, but not about where are we going to put new money to. So this is an area where there's good opportunity, at least perhaps pre-listing. There's a lot of opportunity, but we need, like you said, some of that consistency and coordination of the policy overall in order to make it flourish a lot better. So I think those are the areas. In digital, yes, sustainability is another area, and more that can be done. We play a role ourselves in playing this through our dana impact as well as through our investment activity.
Well, thank you, Feisal. Well, you mentioned about the transition to electric vehicles. I think that's something which is inevitable, and I think you can already see from policy perspective with the stamp duty and tax waiver, the new electric vehicles are 20% cheaper than their ICE equivalent. So between iX and X5, for example, and so on. So I think there'll be a natural demand for that. But I do hope that there'll be greater movement for the lower end of the market. I always believe that there's room for affordable EV segment, and this is something perhaps PMB with Purdua and so on, and of course Proton as well will be developing, because otherwise, as we move towards EV, then we will find that there will be supply that's not, or demand is not being met by supply, especially for the affordable EVs, if I may. Sorry, Pranik, perhaps a quick comment from you on this. Thank you.
Yes, thank you, Tan Sri. So building on our investment capabilities, for Co-op, the most investment opportunities we see are in green businesses as they cut across all industries. So from our perspective, green businesses would support long-term growth, which is our main aim anyway. So in essence, they are more productive. They will be efficiency in terms of the use of natural resources, reducing waste, energy consumptions, and also unlocking opportunities for innovation and value creation. And over and above that, of course, allocating resources towards the highest value use. So because of that, we expect them to also be able to reduce costs the most. And I think they would tend to have more robust risk management framework because they would have to deal with transition risk factor due to climate change. And we think that they would avoid owning stranded assets. I think Dato Feisal just now mentioned as well. And I think they will also have lesser regulatory risk. I think I've mentioned just now, right? The governments around the world are all enacting stricter measures ahead. So from the demand side as well, so we are seeing growth as far as the sustainable products as demanded by more consumers. Over and above that, Tan Sri, I think according to Bloomberg Intelligence, global ESG assets are expected to exceed $50 trillion by 2025, which is more than a third of global AUM then. So it's not something that we can afford to ignore. And besides that, we are also investing in digital and infrastructure. So it is a given because we also want to help these companies, Malaysian companies, to expand beyond Malaysian shores. So under our private market portfolio, one of our invested companies, for example, is currently the largest in the world in drone services that leverages on for IRR. And when we first invested in the company, it was ranked at number 7. Another company that we are currently investing in is the 6th largest in the world in terms of telco tower services compared to the position it was at 12th largest when we first invested. So
are you referring to Aerodyne and Edotco respectively?
I'm not supposed to mention in name, kan?
Okay,
so basically, those are the 2 companies that we have invested that have done well. So, but having said that, what we see is that investing in these areas would require quite deep skill sets in terms of analyzing and monitoring. So they are generally in the private market space, right? But of course, they also would offer, hopefully, inshallah, much better return with higher risk due to the illiquidity risk. Hopefully, we will get them ready to be listed soon, Tan Sri. Thank you.
Sure. Well, thank you. Great to hear that. Now, if I may, I do want to get into that conversation about the financial sector. Now, my view is actually one of the mainstay of the Malaysian economy, apart from the diversified structure of our economy, is also the fact that we have a very strong, resilient, and fully functioning financial system. And to me, we have all learned from the crisis of the past. Well, today, if you look at our banks, they are very well capitalized, they are more liquid, they are better managed, and they're very much effectively regulated and supervised by Negara Malaysia. Now, you heard from Anand talking about capital adequacy. So as of the end of 2021, for example, the common equity Tier 1 ratio of the banks was 15.2%, good asset quality with net impact financing ratio below 1%, and loan loss coverage of more than 142%. So obviously it augurs well for the economy, and it also gives you that opportunity for the banks itself to be good investments. So Anand highlighted quite a number of banks just now. Of course, he's not able to showcase Maybank given the conflict, but I understand in terms of dividend yield, for example, Maybank provides one of the highest dividend yield. So if I may perhaps get the views from Dr. Suhaimi and Rick in terms of where you see further progress in the financial services sector. Do you see further consolidation that would create excitement in the market, and do you see digital banking licensees providing that competition to the incumbents that will affect value and so on. Maybe let me start with Datuk Sri Amir.
Thank you, Tan Sri. I think the banking sector has always been a huge sector in Malaysia that a lot of us are invested inside. I think over the years we've seen that there are some dominant players inside this. I think at last count 26 players inside this space. Yeah, but the top 5 probably account for something like 48% or something like that of the share of the space. Yeah. So the bottom part of the market is actually quite small. Yeah, played by a lot of players, and I think that it is probably a segment that is probably due for some form of reconsolidation, if you want to call it that. Yeah. I think as you're all aware that within EPF, we do have a couple of strategic investments in the banking sector. And one of our strategic investments have also started the process of consolidation. We have a transaction that's actually ongoing at this point. I won't be talking about the transaction per se, because I think that's let the organization run with it. But I think it does talk to the fact that there are opportunities, and for a shareholder perspective, when there are good and sound things, we as shareholder highly encourage the sector to consolidate and to release value from that consolidation effort. I think going forward, digitalization is a big game changer. We've seen a lot of efficiencies come up from digitalization, enabling a lot wider coverage, and Bank Negara's digital license, bank license is actually quite facilitative of helping to open up segments that were underserved or unserved to this space. And I think it can only augur better for Malaysia in facilitating that. And again, from a EPF point of view, we are supportive of this transformation, and we look forward to opportunities that come up, and will actively support when we can see the value come out on the table. This doesn't mean, of course, it's going to be easy. Yeah, because ultimately it does mean in realizing value, you will have to cross some very, very difficult questions. Yeah. But I think that as long as we're clear that the reform is necessary for the long-term stability, I think we should support.
Thank you, Dr. Syame. Rick, as the owner or the shareholder of the largest bank in Malaysia, any comment?
Actually, firstly, I must say it's daunting to answer that question, given there are 2 people here who used to be the CEO and the CFO of that largest bank. But I must say, PNB, we do like the financial sector. 40% of our domestic portfolio is in banks. Although we're most well known for our ownership in Maybank, 48%. We also own stakes in KIMB, RHB, Mbank, and so on. So the financial sector is for us a sector that consistently delivers dividend, and our portfolio and our unit holders expect that. I guess the question on consolidation, one thing I'll say is the market is very different than where we were in 2001 financial crisis. We had 50+ over banks, and then the benefits of consolidation down to 10 anchor banks truly made sense, and we are in a way reaping the benefits of that. Strong capitalized bank, highly resilient. Having said that, I do think there are benefits for further consolidation. As Dato' Sri Amir said, they are still subscale banks. As you think about higher compliance costs, non-traditional competition, you do need to invest and scale up. And secondly, the whole digital game, you do need to invest into core systems and technology to do that. And I guess lastly, if you're the regulator, it's always easier to manage a smaller set of banks than a larger set of players, right? So there are benefits from consolidation. But having said that, and we've looked at many successful mergers, not so successful mergers, potential mergers, and a lot of times those mergers, to make the numbers work. And for us, what we mean by making the numbers work is we always want to make sure that dividend payout remains and we get our dividends, is they all have to rely on some form of revenue or cost synergies. Oftentimes those synergies tends to be exaggerated a bit, but so for us the cost side is a bit more reliable than the revenue side. But as investors into this sector, to be honest, what we look for is ROE, return on equity, and strong ROE. If you look at it, I think the sector as a whole ROE has come down a bit from the low double digits that we had a few years ago. Now most banks are mid single digit, but a lot of the anchor banks, Maybank via its M25, CIB with its Forward 23, all have a strategy to get back to that 11, 12, 13%. I think Maybank even stretch it to 15% ROE. So we are looking for that ROE, whether or not that and I think a lot of it will probably come from the cost side, more so than the revenue side. But we do recognize banks do have still room to grow. Asset management, SME as a segment typically are where there's still room to grow in Malaysia. But we always talk when we talk to our portfolio companies. We always say you don't necessarily have the right to grow. What you need to be focused on is ROE, and if the ROE comes from the cost side, so be it. But yeah, I do think there's some benefits from consolidation, but mostly at the subscale, amongst the subscale players.
Thank you, Rick. Dato Feisal, as the former banker yourself.
Thanks, Tan Sri. I just left the industry about a year ago, slightly more than a year. When I look at this space and look at consolidation, of course, the first thing we would normally look at is the customers. Would the customers be affected in a bad way should there be consolidation? But I think when you actually look at a country such as the 30 million population, you've got 8 main banks. I just calculated before, if you actually include Islamic banks, the DFIs, and all the other banks, including foreign banks, I think there's about 43 licenses. So I think I don't think that the consumer will be affected, I think, in a way. So, but then when you look at the industry itself, compliance cost is getting astronomical. It's huge. You've got capital is becoming really, really expensive. So when you have smaller entities faced with all these pressures on capital, on compliance, it's very difficult for them to innovate and go into shift to digital, for example. So for that reason, I think it actually helps to be sizable. So you can innovate, you can shift. There's a lot more that you can do instead of being small. So I think when you actually look at consolidation, it makes a lot of sense. Pre-COVID, I remember the time when the smaller players were really, really paying up for deposits, and NIMs just compressed because of that competition for deposits. So it makes a lot of sense. Now, the question is timing and pricing, and price. Because I think it makes a lot of sense for people to merge, and we are kind of like see various permutations of that happening. It is a question of valuation at the end of the day, and whether by not doing anything will be more expensive than doing something. But I would see that this is a space that requires more consolidation.
Thank you, Dato Feisal. Wanik, I know Co-op doesn't have a bank yet. Any thought?
Sri, as you rightly say, we don't have a bank in our stable. In fact, if I may, we actually don't have any companies that, how shall I say, in our stable or Co-op related. Co-op's mandate is not to build companies to be associated with us strategically. All of our investing companies are portfolio investing companies. So our mandate is to grow the fund size and remain the best professional fund manager for the pensioners, for our pensioners, as well as for the pension ecosystem. So we don't want to dilute our main objective, right, by taking control of any companies. But for that matter, if there are opportunities due to the consolidation that I'm hearing today, we will actually take opportunities, right, to basically participate if, of course, it enhances our fund growth further. And as well, I completely agree, our banking system currently is at an exceptionally good place today. It is interesting indeed that it took Asian financial crisis, right, to make us stronger and better. And just to share, perhaps to show that our confidence in the financial sector, our exposure at total fund level is at 18% currently. So what I would like to see during the current crisis that we're in, as well as the challenges that we're facing, how to get basically the financial sector to be more involved as far as improving the well-being of society as a whole. Because I'm hearing from some of the banks, many of the banks who are currently quite conscious in terms of how they can assist the SMEs, right? To grow and to be beefed up further, to be strengthened further. So I see that the role of financial institution is no longer just about to provide simply funding. I think we have, as I mentioned just now, we have invested in certain institutions that I think they are currently playing stewardship role to support the SMEs further. So we are hoping that these SMEs would be assisted to embrace volatility, right? For them to be aware that the potential challenges or headwinds ahead, as well as to take opportunities during those headwinds for them to be growing bigger and stronger, as well as hopefully one day ready for listing as well. So we have taken actually last year a small company in logistic industry, which is very fragmented. So we managed to make it larger, and it successfully went for listing last year, alhamdulillah. So I think with that intention, I think that is the one strategy that we intend to be participating more of. I think supporting SMEs would be very crucial for us as a nation to grow ahead, because SMEs, as we all know, it is the backbone of our nation anyways.
Well, thank you, Panik. There are a number of questions on the banking consolidation in the Q&A box. One of them asked about whether it should be mandated or should be driven by the respective shareholders and so on. So I guess from our conversation, I think there shouldn't be any mandate or forceful merger per se. It should be commercially driven. It must be value driven. It must, at the end of the day, bring value to all the stakeholders, including the shareholders, I suppose. But I think one opportunity would be in terms of perhaps converting some of the banks into Islamic banks, because to me, that's something which is there's a value proposition, and in fact, if you look at the listed equity instruments, we have very few which is Sharia compliant in the financial services sector. So I think that's something perhaps that can be addressed, if I may. Now, on the last part, I will going back to this the heading, the theme of our conversation today is about why Malaysia. So I would like to use this as the closing page for the four of you in terms of why Malaysia, and what are some of your thoughts in closing, and perhaps also whether we should be looking at having more quality public listed companies to be listed on our exchange. We have quite a number in the pipeline, which we'll hope will come to the market soon. Of course, in the past, there have been conversations about QSR. There've been talk about Datuk Feisal E.co. There's also questions about shouldn't we have the biggest insurance company under a certain banking group to be listed, and many others. So maybe you can actually provide your comments. Let me start with Panik first. Your closing remarks.
Yes, the way we see it, okay, let's consider Malaysia as the biggest institutions amongst us all here. You know, all of us put together, we are about 1.6 trillion ringgit, about the same size as Malaysia's wealth. So, and as we all know that Malaysia is a very rich, exceptionally rich nation. We have palm oil plantation, right? We have gas, we have electrical and electronics, which accounts for more than a third of our exports. And we have gloves, a bit, of course, going through some challenges currently, as shared by Anand earlier. and not forgetting as well our talents that are so well regarded globally. So we are a well-diversified economy. So not only from macro perspective, now that Malaysia I think it is currently the fastest growing economy in the world, right? With 8.9% the second quarter. So we have many other strengths to offer as well, which includes the four of us right here, right? We have robust institutions, backed by well-balanced capital market and strong regulatory system. In fact, we are ranked number 12 out of 190 countries in the World Bank's ease of doing business in 2020. Our growing middle class, our potential to benefit from supply chain disruptions that are currently happening, with China being locked down and so forth. So those are certainly very obvious. So what can we do better? So just like running any institution, right, for the foundation to be strong, right? So I think for us, for Malaysia, perhaps to look at our own enablers, similar to the 5 enablers that COP had identified earlier under Teras 5. So one enabler that must be on ongoing process for improvement would be the process to invest, right? For our FDIs to come to Malaysia, perhaps having that one-stop center for FDIs as well as for business owners to go to for all matters to ease their processes to get information or to get approval and so forth. So I think we also to leverage on our diversity, which we currently have, be it human capital, economic diversity, as well as strengthen our competitive spirit in the global arena. So we are up against some very strong competitors regionally, and some are making headways. But so for me, we have all the right ingredients. I think it's just a matter of time for us to continue to grow even stronger going forward.
Thank you, Puan. Dato' Suhaimi.
I think overall, I think Puan talks about all the right foundational elements. I think the changes in geopolitics have really dramatically altered things in the world today. And I think one of the concepts that Rick talked about just now is the shifting of supply chains from just in time to just in case and so on. I think that there are a lot of underlying changes that are going through the system, and Malaysia offers itself as an opportune place for people to talk about reallocating, putting new things on the ground, because we've got the talent, we've got the resource, we've got the capacity, and there are a lot of institutions here are probably looking at supporting growth on that line. And if you look at from an EPF point of view, we're very positive for Malaysia. We said it earlier this year when we were talking about our asset allocation. We are increasing our allocation into equities in Malaysia, not only for large cap, but also for mid and small caps inside. From the private equity space, EPF has allocated about 1 billion ringgit to prompt growth in this sector, because we need a much more robust engine that ultimately will also feed Bursa in terms of listed entities, and that has started here because we believe that providing liquidity in that market will create bigger, better organizations that ultimately will feed our engine. And even in the supply chain basis, EPF is investing also on real estate on a supply chain logistics growth, because we can see growth coming to Malaysia.
Thank you, Suhaimi. Rick?
So overall,
sorry, go ahead.
Go ahead. Sorry.
So you wanted to say overall?
No, I said overall we're optimistic, and we're putting money where our mouth is.
Thank you, Suhaimi. Rick?
Yes, I think firstly, what I'll say is PNB is a big investor domestically. 80% of our portfolio is still in Malaysia, and we are, last time I checked, close to 10% of the market capitalization of Bursa are PNB held companies. I think for me, the why Malaysia previously was very clear. We were a place with good but cheap labor, good input factors, energy costs was low, and we were fairly connected. We have, the last time I checked, 14 FTAs, right? Bilateral and regional FTAs. So that made us a fairly compelling destination for investors. And most importantly, we had policy continuity and a whole of government approach to strengthen that. I think moving forward, the why Malaysia of the past needs to change. We cannot rely on cheap labor, cheap energy, and all that. That will have to change, and it will require investment from Dana Impact that Khazanah is doing. It will require new sectors and so on. But more importantly is I think we need to be very clear what's our investor proposition. So for me it is emerging, and we need to recognize that other countries and economies around us have come up. So we do need to be a lot sharper. Why Malaysia question, but more importantly, I think whatever we do, we just need to have policy continuity and consistency, so that investors and like us and investors from outside, when they look at Malaysia, they understand, okay, for Malaysia, this is where they're heading, and this is what they're gonna do. Because to be honest, we have a lot of plans. Every sector has a plan, but obviously the question is there continuity around the plan? Is there coordination around the plan? Which obviously are important questions for investors. Now, what will we do, PNB, to strengthen why Malaysia? I think first and foremost, we are going to work through our companies to ensure that they have a compelling business model. They are focused on delivering returns, and they continue to grow well. Whether it's Sime Darby Property, EMW. First and foremost, we think they cannot stay still. They need to pivot and transform their business, and by doing that, it strengthens one part of why Malaysia. Secondly, PNB itself needs to transform. In the past, why did all of us invest in PNB? Is because it gave us a cheap way to access the equity market. But today, you can access equity markets very, very cheaply on your own. We need to have a very different proposition to the investor base in Malaysia, from the sophisticated investors here to the Pakcik Kampung that wants to access private equity investments and so on. So we ourselves have to transform, and by being, and I think more importantly, what the role that we play, and I think it will make Malaysia more compelling, is the governance and the stewardship. If we go in and really focus on investment stewardship, governance, sustainability, our companies will become attractive for investors to invest in, and the why Malaysia becomes a lot clearer. So for me, that's my takeaways for today.
Thank you, Rick. Well said. Dato Feisal, you have the privilege to be the last speaker to speak.
Thanks, Seri. Why Malaysia? You can look at it from two aspects. One would be the fundamentals, which I think Puan talked about, and that's really looking at what we're blessed with. I mean, if you look at it, we have a prominent role in the global supply chain. Rick mentioned about just in case versus just in time. Call it China +1 or China +2. We're quite unique in a sense because we play a neutral part when it comes to geopolitics. We're very, very unique and actually being well positioned for that supply chain. The other thing is we are blessed with the infrastructure that we have, whether it's services, logistics, infrastructure. We also have a conducive and competitive business environment. There's a number of things that we have, which I would say it's opportunities, right? Which is basically potential for energy transition, talking about, I mentioned about supply chain relocation, sustainability related investments, which I mentioned to you about. And now food security is becoming important as well. And our country is actually well suited for that as well, especially for halal. So when you actually look at all these things, the basic ingredients, the infrastructure is there. Now, the next part of it, and why Malaysia, is let's look at the companies themselves, which are listed. And here I want to bring back to what Anand mentioned. Why I'm going to bring back what Anand mentioned is because I do remember this time last year when I first became the MD of Khazanah, I remember somebody, it could be Anand, described Malaysian companies as rather boring, old economy. And then when it comes to declining returns, the shareholders, i.e. clicks, perhaps they don't do much, okay? And it becomes very boring, right? So now, you fast forward into this year and you hear PNB, you hear EPF, it's the same with Khazanah, where we're not gonna allow these companies to go sideways. I think there's a number of things that you can see. It's not like how it was before when we had the Putrajaya GLC transformation program. It's not like that. It's not a program, but you hear the same tune being mentioned by all the GLICs, which is we're going to look at the boards. We want to make sure that they're effective. We want to make sure that the board dynamics is there. We want clarity of strategy, and the clarity of strategy links back to shareholder value. We want to be able to see that. We want to make sure that the management lineup can actually execute that. And if we don't see it, we're going to voice our opinion via shareholder votes, our rights as shareholders. So we hear that from each of the GLICs. So it's not a program as before, but you hear the GLICs saying the same tune, and we're going to see it. We have seen it. So this is something which is a bit different than before, because we can't see, at least the GLICs or GLCs, behaving as how they would behave before. Yes, we have the pandemic, people are coming up, we see it as an opportunity, but with shareholders speaking this way, you can see a lot more potential for value creation going forward. And we do see the push for sustainability, the push for digital. So again, that will improve productivity as well, pivoting the companies to the right strategies. So now, having said that, it's also beneficial to have companies such as what we have, just like what Anand mentioned a couple of hours ago, defensive, high yield. So when things are bad, it's also good because it's defensive and we have high yields. But what you will see is the potential for growth going forward, given what we hear from the GLICs. That's why Malaysia.
Well, thank you, Dr. Feisal. Music to many of the people's ears, I would say. Now, for us at Bursa Malaysia, obviously, we play our part to be the marketplace, where it's actually the marketplace where we have public listed companies being listed, being matched with investors and facilitated by our various participating organizations. So the success of our market will very much be dependent on the quality and performance of our public listed companies. Now, our more than 900 public listed companies, they come in various shapes and sizes, different level capacity, and that's why, from our perspective, where we can provide guidance, where we can help, we will actually offer that as well. And this is actually why we, arising from the workshop that we undertook 2 years ago, initiated the PLC transformation program, gap books, where we identified 5 areas. We already issued the 2 gap books. One was on creating purpose and performance-driven PLCs. Second was about being sustainable, socially responsible, and ethical PLCs. So those 2 issued already. The next one coming up would be strengthening stakeholder management and investor relations. So that's to be launched soon. And we have another 2 to be released in the 4th quarter. And that's on being digitally enabled and contributing towards nation building. Again, these are not meant to be prescriptive, but guidance, especially for the many medium-sized entities where they can take some guidance on. So with that, I would like to thank our 4 esteemed panelists, Datuk Feisal, Datuk Seri Amir Hamzah, Puan, and Rick, for enlightening us on the GLC's perspective on why investors should look at Malaysia. Thank you so much for all your views. Very much welcome. And thank you to Maybank Investment Bank and to our team at Bursa Malaysia for this event. And over to you, Amira.
All right, thank you so much, Tan Sri, and all of our panelists. With that, that is the end of our event. I hope all of you enjoyed our sessions today. Thank you so much for being with us today, and hope to see you all again in our upcoming events. See you all. Take care.
Thank you. Assalamualaikum.